Welcome back to the deep dive, where we decode macro, liquidity, and global incentives. It is great to have you with us today because today we are doing something a bit different. We're stripping away the charts, the endless spreadsheets, and honestly just the noise of the financial news cycle to confront a very uncomfortable truth.
Yeah, it's a truth that I think almost everyone in this game learns the hard way. Usually more than once, if we're being honest. And it's the kind of truth that, it makes you want to quit entirely until you realize it's actually the secret to winning.
I love that setup. So I want to start with a scenario that I think every single person listening has experienced. And I don't care if you are trading your own account with 5 grand in it, or if you are managing institutional money with 5 billion. We have all been here.
Oh, absolutely.
Picture this. You have done the work. I mean, you have really, really done the work. You've read the central bank minutes, the boring parts, not just the summary.
Right, the footnotes.
Exactly, the footnotes. You've built the valuation models. You've looked at the geopolitical risk. Your logic is just absolutely flawless. You have a thesis that is bulletproof.
You feel like you've solved the puzzle, like you've finally seen the matrix.
Yes. You place the trade with total conviction. You size it up because, hey, the data is clearly on your side. And then the market immediately rips in the exact opposite direction. It doesn't just move against you, it decimates you.
Yeah.
And it feels personal. You are left staring at the screen screaming, but I'm right, the data supports me. This doesn't make any sense.
It is a totally visceral feeling. It feels like an injustice.
Mhm.
It feels like someone literally stole from you.
It does. It really does. And the question we are asking today is why? Why does that happen? Why do smart people with good data lose money to a market that just seems to be acting crazy?
The blunt reality. Because the market doesn't care.
Yeah.
It isn't looking at your spreadsheet. It didn't read your report. And it certainly isn't impressed by your IQ.
That is a tough pill to swallow. I mean, we spend so much time trying to be smart in this industry. We prize intelligence above literally everything else.
We do. But the core theme of today's deep dive is exactly that. It's the friction between human analysis, which is logical, it's narrative-driven, it seeks patterns, and market reality.
Which is what exactly, if it's not logical. Because
Yeah.
if you tell me it's just random, I'm going to pack up my desk and go home right now.
Oh, no. It's not random, but it's not logical in the way we think of, like, a debate. It's mechanical.
Okay.
We tend to treat markets like a high school debate club where the best argument wins. We think if we present the most coherent case for why, say, the yen should weaken, look at the interest rate differential, look at the trade balance, we expect the market to nod politely and say, you know what, you're right, let's reprice.
Fair point, sir. Let me just adjust the chart for you.
Right. But markets are actually just an impersonal mechanism for clearing risk. They are an aggregation engine, nothing more.
But the real story is, and I want everyone listening to really hear, this indifference isn't a bug in the system. It's the defining feature.
Precisely. If the market cared about our feelings or our logic, it wouldn't work.
So let's unpack this idea of the macro environment and the indifference of the system. Because when we say impersonal system, that sounds a bit abstract. It sounds a bit philosophical. What are we actually dealing with here in practice?
Think of it like a weather system.
Mm-hmm.
That is the best analogy I've ever found for this. When a storm forms, it aggregates atmospheric pressure, temperature, humidity, wind speed.
Right.
It doesn't rain because it agrees with the weatherman's forecast. It doesn't rain because you just washed your car and it'd be unfair to rain now. It rains because the physics of the system dictate that moisture must be released.
You can scream at the clouds all you want, but the pressure system doesn't hear you.
Exactly. Markets are exactly the same. They aggregate capital, risk, and incentives. They do not aggregate narratives or coherence or intelligence. $1 billion of sell pressure from a panicked pension fund facing a margin call looks exactly the same on the tape as $1 billion of sell pressure from a brilliant hedge fund manager who thinks the asset is overvalued.
Wait, hold on. That distinction is crucial. You're saying the market mechanism, the actual matching of buyers and sellers, is totally blind to the intent of the order.
Completely blind. The market doesn't tag the money with a little sticky note saying smart money or forced selling. It just clears the order book. If supply exceeds demand at the current price, price goes down. It does not matter why the supply is there.
That leads us to the biggest trap, which is the participant's fallacy. We were talking about this before we started recording. Break that down for us. What is this unspoken assumption we all walk around with?
It's an entitlement issue, frankly. And it's not because traders are inherently arrogant people, but it's how we are trained from birth.
Yeah.
Most of us go through an education system where if you study hard, you get an A. If you work hard at your job, you get a promotion. We are deeply conditioned to believe that effort equals reward.
Input equals output. It's the basic social contract.
Right. So we bring that conditioning right into the market. We assume that a well-reasoned view deserves a payout. We believe that if we put in 80 hours of research, if we read every single annual report, the market owes us a return on that cognitive investment.
Oh, man, I feel attacked right now. I have definitely felt that. Like, I spent all weekend analyzing the setup. I deserve a win here.
We all have. I remember early in my career spending literally weeks building a model for a specific commodity trade. I knew everything about the supply chain, the shipping routes, the weather patterns in Brazil.
You had it nailed.
I had it nailed.
Mm.
I put the trade on, and it didn't just fail. It didn't even move. It just sat there while I bled carry costs. I was furious. I felt like the market was broken.
But the market wasn't broken.
No. My model was perfect, but nobody cared. The flows weren't there. The reality is that markets do not evaluate analysis. They absorb positioning. They don't distinguish insight from noise. They reconcile flows. You can be the smartest person in the room, totally correct about the fundamentals, but if the flow is against you, you lose.
It's the difference between being right in a literary sense versus being right in a survival sense.
Yes, the market is not a referee grading your essay. It's a meat grinder.
Let me play devil's advocate here, though. Because if we say analysis doesn't matter, aren't we just advocating for gambling? I mean, Warren Buffett reads reports. Ray Dalio studies history. Are you telling me they're just wasting their time?
No, absolutely not. And that's the nuance we really need to nail down. Analysis is vital for identifying opportunity and managing risk. But analysis does not cause price movement. That's the key distinction.
Okay.
Buffett doesn't buy a stock and expect it to go up because he analyzed it. He buys it because he believes the discrepancy between price and value will eventually force the flows to align with reality. But he knows full well he might have to wait 5 years.
Okay, so the market doesn't care rule is largely a timing and mechanics issue.
Exactly. Over the long run, and I mean the very long run, markets tend to align with fundamentals. Gravity works. But in the short to medium term, it's all about liquidity and positioning. And short term can be longer than you can remain solvent.
The market can remain irrational longer than you can remain solvent, the classic quote.
Keynes said it best.
Let's zoom out for a second and look at why we actually do this analysis if the market ignores it in the short term. Because let's be honest, we obsess over it, we love the charts, we love the narratives, it's our whole industry.
We do. And we have to admit why we do it. Most of the time, analysis serves a hidden function. It's a psychological crutch.
A crutch? In what way?
Well, if analysis doesn't move price, what is it actually for? It's for us. It provides structure and uncertainty. It creates coherence and complexity.
Yeah.
Humans are pattern-seeking machines. We cannot stand chaos.
That's true.
If I look at a chart that is just jagged lines moving randomly, I feel anxiety. I feel a total lack of control.
So I draw a trend line, I add a moving average, I pull up a news report that explains why the drop happened at 2 p.m.
Exactly. And suddenly, the chaos has a shape. You feel better. You feel agency. We project causality onto a surface, the market that often offers none. The key insight here is that analysis often serves the analyst, not the trading account. It reassures us that the world makes sense.
It's like a safety blanket. I have a thesis, therefore I am safe.
But that reassurance creates a very dangerous conflation. And this is where accounts get blown up. This is where people lose their houses.
Talk to me about this conflation, because it feels like there is a trap here where we confuse our internal feelings about the trade with the external reality of the trade.
The mental trap is that we begin to feel that because a thesis is well constructed, it must be consequential. We confuse effort with influence. Just because you worked hard on the chart doesn't mean the market respects the support line. The market doesn't know you drew it.
I love that line. Just because you worked hard on the chart doesn't mean the market respects the support line. It's so incredibly obvious when you say it out loud, but in the heat of the moment, we stare at that line on our screen like it's a concrete wall. Like it has to bounce here.
It has to hold. Why? Because you drag your mouse across the screen. The market is a $100 trillion steamroller. Your line is chalk on the pavement.
And we confuse correctness with alignment. You can be logically right to say inflation is too high, the central bank should hike rates, but you can be structurally wrong.
Right. Let's say you're dead right about inflation. But let's say everyone else is already short. The trade is immensely crowded. The borrow cost is high. Liquidity is super thin. A tiny bit of buying squeezes everyone out. You were right on the macro, but you got stopped out on the wick. You lost money.
This leads to what we call the substitution effect.
Yes. Over time, for many market participants, analysis shifts from being a tool for orientation to a substitute for participation. We start performing analysis for the sake of the analysis itself. We write the newsletters, we make the slide decks, we debate endlessly on Twitter, we get our dopamine from the insight. Meanwhile, the market operates without reference to any of it.
We are playing a video game in the lobby while the actual war is happening outside.
That is a brilliant way to put it. We are optimizing our loadout in the menu screen, feeling very, very prepared, while the market is out there just executing orders.
You mentioned Twitter or X or whatever we call it now. I see this analytical density everywhere. Charts that look like spaghetti.
Oh, the Jackson Pollock charts.
Yes. Clouds, lines, oscillators, moon cycles, you name it. Let's dig into that analytical density concept. Why do we do that? Because I assume people think it makes them more accurate, right?
This is one of the most insidious habits in the industry.
Hmm.
And it's insidious because it looks like work. It feels like diligence. If I'm sitting there with 5 screens open reading a report on soybean futures in Brazil to trade the euro, I feel like I'm being a real global macro strategist.
You feel like you're in the war room.
Exactly. But let's look at the actual mechanics of information processing. There's a concept in information theory, and this is backed by real studies, that suggests past a certain point, more information doesn't increase predictive accuracy. It only increases confidence.
Wait, say that again? That is huge.
More information increases confidence, not accuracy. There was a famous study done by Paul Slovic. He's a psychologist back in the 70s with horse handicappers.
Horse racing.
Horse racing. These were pros. They made their living betting on horses. He gave them 5 pieces of information about the horses: past speed, jockey weight, track conditions, whatever. He asked them to predict the winner and rate their confidence.
Okay, makes sense.
Their accuracy was decent, and their confidence basically matched their accuracy. Then he gave them 10 variables, then 20, then 40.
So they have every tiny detail imaginable.
Every detail. And here is the kicker. With 40 variables, their accuracy hadn't improved at all. It flatlined. But their confidence, it went completely through the roof. They were almost certain they were going to win.
So they were just as wrong as they were with 5 variables, but they were way more sure of themselves.
Precisely. And that is the absolute danger of analytical density in markets. When you layer on the soybean harvest on top of the ECB minutes, on top of the Fibonacci retracement, you convince yourself that you cannot miss. You think, I have covered every single angle.
And when you are that confident, what happens to your position sizing?
You size up, you take on way too much leverage because you're sure. And that is exactly how the market kills you. Not by being unpredictable, but by exploiting your overconfidence.
So the market indifference we talked about, it's not just that the market ignores your analysis. It's that the market is a mechanism that specifically punishes the behavior that comes from bad analysis.
That is a brilliant distinction. The market doesn't target the analysis. It targets the positioning that results from the arrogance of the analysis. If everyone reads the same newsletter and everyone piles into the same smart trade, the market seeks liquidity. And where is the liquidity?
It's at your stop loss.
It is at your stop loss.
Yeah.
And the market will go there, not out of malice, but because that's where the orders are resting.
Now here's where it gets interesting, specifically regarding the mechanics. Because if the market isn't listening to our logic, and it's not reading our newsletters, what is it listening to? Let's pivot to the hidden incentives.
We have to talk about constraints. Capital does not negotiate with interpretation. That's the core concept you have to internalize.
It's the fundamental law.
If we strip away the stories, what drives the machine? Drivers are constraints. They are shaped by incentives, regulation, liquidity, and risk tolerance.
Give me a concrete example of that, because constraint sounds a bit academic. Give me constraint versus a narrative in a real, live trade.
Okay, let's look at a hypothetical scenario, but one that plays out literally every quarter.
Yeah.
Narrative is, Apple just released a revolutionary phone, record sales. The stock should absolutely fly.
It makes total sense. Fundamental value is up, so you buy.
Right. But now look at the constraints. Let's say there's a massive pension fund that holds a huge portfolio. They have a strict mandate. Technology stocks cannot exceed 20% of the total portfolio.
Okay, that's a hard rule for them.
A hard rule written into their charter. Now, because Apple's price went up on the good news, suddenly tech represents 21% of their portfolio. They are now offside. They are actively violating their mandate.
Because they have to sell.
They have to sell. They don't have a choice. They don't hate Apple. They probably love Apple. But the math says Sell $500 million of Apple by 4 p.m. to get back to 20%.
So the narrative says buy because the company is doing great, but the constraint says sell immediately because we are too successful.
Exactly. And who wins? The constraint wins. Every single time. The market is a mechanism where capital reallocates in response to pressure. The price drops because the massive sell order hit the book, not because the company's prospects suddenly changed.
And the market doesn't care why that fund is selling.
No. Markets are not counterparts in a conversation. They have no memory. They have no intent. They have no judgment. They don't know that the selling is forced. They just see supply exceeding demand at the current price, so the price moves down until it finds liquidity.
This is why it feels so cold. I think a lot of retail traders feel punished by the market. You hear it all the time. The market is out to get me. They hunted my stop.
That anthropomorphism is totally natural, but it's deadly. The market didn't punish you. It didn't even know you were there. Interpretation happens entirely on the participant side. You interpret the loss as a punishment. The market just executed a math equation.
I want to go deeper into the plumbing here. You mentioned liquidity and the order book. For the listener who hasn't spent years staring at a DOM, depths of market ladder, can you explain what actually happens when price just rips? Because it's not magic.
Sure. Imagine the order book as a wall of bricks. The bricks are limit orders, people waiting to buy or sell at a specific price. I'll sell 100 shares at $50. I'll sell 500 shares at $50.01. That's liquidity. It's a wall.
Okay, so the wall stops the price from moving freely.
Correct. To move the price up, you have to buy all the shares at 50, then all the shares at 50.01. You have to literally chip through the wall. But sometimes the wall vanishes.
Why? Why would it vanish?
Maybe news hits. Maybe the algorithmic market makers turn off their machines because volatility just spiked too high. Suddenly, there are no bricks between 50 and 55.
An air pocket.
An air pocket. A total liquidity vacuum. Now, if I send a market order to buy, it doesn't get filled at 50. It slips all the way to 55 instantly. That's the rip. It wasn't that the fundamental value of the company changed by 10% in 1 second. It was that the liquidity disappeared.
That is terrifying when you think about it.
It is. And your narrative about fair value, it doesn't mean a thing in a vacuum. If there is no liquidity, price goes wherever it has to go to find a trade.
This connects directly to the institutional side. We talked about the pension fund.
Okay.
But let's talk about VAR, value at risk. Because retail traders often think the market is this shadowy cabal of guys in a smoke-filled room making decisions to screw them over. But institutional players, the real whales, they are just as constrained, aren't they?
Oh, absolutely. In fact, they are way more constrained. This is what retail traders almost always miss. They think a hedge fund manager is sitting there like a cowboy, making gut calls on the fly.
Like, I just have a feeling about Tesla today.
Never happens. That manager has a mandate. They have a risk committee. They have regulatory limits. And they have VAR models.
Explain VAR for us really quickly.
Value at risk. It's a statistical measure. Basically, the computer calculates, based on current market volatility, how much could we lose in a single day? If volatility spikes, let's say the VIX jumps from 15 to 30, the math suddenly says you are holding too much risk.
Even if the positions themselves haven't lost money yet.
Even if they are wildly profitable. The volatility itself triggers the risk limit. So the risk manager walks over to the desk, or more likely, an automated system just kicks in and says, sell 20% of the book, now.
Sell it now, not, hey, let's sit down and discuss the macro thesis.
No discussion whatsoever. It's a forced liquidation. And that is the ultimate example of markets not caring about your analysis. That fund isn't selling because they analyzed the company and found a fundamental flaw. They are selling because a math equation on a risk server somewhere triggered a mandatory action.
And if you, the individual trader, are sitting there trying to analyze the chart patterns while a $50 billion fund is structurally forced to dump assets, you are going to get run over.
You are standing on the train tracks, analyzing the paint job on the train while it's coming at you at 100 miles an hour.
Let's talk about a real-world example of this forced selling. I'm thinking of the UK gilt crisis in 2022. That was a moment where logic completely broke down, wasn't it?
That is the perfect case study. You had these boring, ultra-safe pension funds using a strategy called LDI, liability-driven investment. Basically, they were using leverage on government bonds.
Which are supposed to be the safest asset in the world.
Exactly. But then rates spiked unexpectedly. The bonds fell in value. The banks called the pension funds and said, we need more collateral. post-cash.
A margin call.
A massive margin call across the entire UK pension system. To get the cash, what do they have to do? They had to sell the bonds,
But selling the bonds makes the price go down even more.
which creates an even bigger margin call, which forces more selling. It was a complete doom loop. The fundamental analysis of the UK economy didn't matter. The political narrative didn't matter. It was a mechanical gear grinding the market into dust until the central bank literally had to step in and stop it.
So if you were a trader looking at that and saying, well, the UK yields are really attractive here, I should buy you, you would have been completely wiped out by the mechanical force of the selling.
Until the flow stopped, your fundamental analysis was just a suicide note.
But the real story is we always try to explain it afterwards. We never just look at it and say, oh, it was a mechanical flush. We have to create a story around it.
We're totally obsessed with the why. And this leads to what we call the illusion of continuity.
What is that?
It's the difference between explanation and influence. We assume that because we can explain why price moved yesterday, we therefore have the ability to predict how it will move tomorrow.
Oh, the market dropped because the CPI print was hot.
Right. We look back and it seems so obvious. Of course it dropped. Look at the data. That is retrospective coherence. We build the narrative after the outcome is already known. This makes events look logical and predictable in the rearview mirror.
But in the moment, before the print, it wasn't obvious at all.
Not at all. It was a coin toss. Or maybe the market would have rallied on the exact same data because bad news is good news for liquidity and rate cut expectations.
That drives me absolutely crazy. You read the headlines, the market rallied on bad news because it means the Fed will cut rates. Then the very next month, the market dropped on bad news because the economy is slowing. It feels like we just fit the story to whatever the price did.
That is exactly what we do. We are retrofitting logic to a fundamentally chaotic system. The trap is that this hindsight strengthens confidence in our analytical skills without actually improving our alignment with future forces. We pat ourselves on the back for explaining history, thinking that makes us futurists.
So we've established that the market is a cold, indifferent machine driven by flows and constraints, not by our clever stories. And we've established that trying to out-analyze it with density usually just makes us horribly overconfident.
Correct.
So what do? Let's talk about the strategic implication, because we have listeners who need to actually navigate this. How do we shift from being the entitled analyst to something that actually works in reality?
We have to deal with the validation trap first. We have to kill the ego.
Which is deeply tied to identity.
Huge.
Yeah.
In finance culture, insight is social currency. We all want to be the smartest guy in the room, whether it's on Twitter or in an investment committee meeting or just at a dinner party. We want to tell the story that sounds the smartest.
And when the market moves against us, it feels like a personal rejection. It feels like the market is pointing at us and saying, you are stupid.
Yes. And because our ego is involved, we double down. We fight the tape. The market is wrong. How many times have we heard that from very smart people? The market is irrational.
The market is ignoring the fundamentals.
The market isn't ignoring them. It's pricing in something you aren't seeing, usually the flows. So the pivot, the move a real pro makes is to shift from persuasion to observation.
Break that down for me.
Most people trying to persuade the market, they try to impose their will. This should go up. A pro observes. It is going down.
Simple, but profound.
You replace prediction with context. Instead of saying the S&P 500 will hit 5,000 by year end, you say the current environment is characterized by tightening liquidity and defensive positioning.
You replace forecasting outcomes with recognizing condition.
Exactly. The goal is to understand the environment without demanding the environment respond to you. It's like a surfer. You don't demand the wave breaks right. You look at the ocean, you see where the swell is, and you position yourself to ride it. If the wave dies, you don't argue with the ocean. You just paddle back out.
This sounds a lot like campaign bias.
Yes, you shift the mental model from being right to being aligned.
Hang on.
If the market ignores the why, your beautiful narrative, you focus on the how. The flows and the liquidity. If your narrative says dollar down, but the flows say dollar up, you respect the flows. You pause the campaign. You don't abandon your brain, but you subordinate your opinion to the market's reality.
Okay, let's get really practical here. How do I actually observe flows? I'm a retail trader. I don't have a $30,000 Bloomberg terminal. I don't have the CEO of BlackRock on speed dial. What tools can I use to stop guessing and start observing?
You have way more tools than you think. First, start looking at the news and start looking at the Commitment of Traders reports, the COT.
The COT report. Explain that briefly for the listener.
It's a weekly report published by the CFTC that tells you what the big players are actually doing. It breaks down positions into commercials, which is the smart money hedging, and non-commercials, which are the speculators.
Okay, so how do I use it?
You look for extremes. If the speculators are massively short, like record levels of short positioning, and the price stops going down, that is a massive signal.
Why is that a signal?
Because everyone who wants to sell has already sold. There is no one left to push the price down. The fuel for the fire is completely gone. Any tiny bit of good news will force those shorts to cover. That's a squeeze. You aren't analyzing the asset anymore. You are analyzing the positioning of the other players.
You're playing the player, not the card.
Exactly. Another tool is open interest in options markets. Look at where the gamma walls are.
Camels.
Without getting too deep into the Greeks, these are price levels where dealers, the market makers, are forced to buy or sell to hedge their own books. Remember, we talk about forced participants. Dealers are the ultimate forced participants.
So if I know there is a huge wall of options at $100, I know the dealers might aggressively defend that level.
Or if it breaks, they might accelerate the move. You are looking for the mechanics of the board, not the fundamental value of the pieces.
So the strategic implication is really about becoming a detective of constraints. Who is trapped? Who is forced to move? Where is the pain?
Where is the pain? Is the single most profitable question in finance. If the market drops 5%, who is in pain? Is it the retail guy holding spot? Or is it the highly leveraged hedge fund? If it's the hedge fund, the drop has just begun.
Brutal, but effective.
It's not personal. It's just mechanics.
Let's touch on the emotional side of this transition before we wrap up, because it sounds easy in theory, just be detached, just look at the data. But we are human beings. We are deeply wired to want to be right. We are wired to tell stories.
It is incredibly hard. We are fighting millions of years of evolution. Our brains evolved to find causal patterns in the savannah. Rustling in the grass equals lion. That kept us alive.
Rustling in the grass equals run.
Right. But in the market, rustling in the grass, a random price tick might mean absolutely nothing. Or it might mean everything. But if you assign a narrative to every rustle, you will burn out in a month.
The participant's fallacy we mentioned earlier, the entitlement, I want to dig into that because I think it directly affects how we deal with losses.
It's the primary source of revenge trading.
Revenge trading. The classic, I'll get it back.
Why do we feel the need to get it back from the market? Because we feel the market took something from us that was rightfully ours. I did the work, I deserved the win, the market stole it, so now I have to go fight the market to reclaim my property.
But the market doesn't have your money. Another participant has your money.
And the market is just the venue. It's like getting mad at the stadium because your football team lost. The stadium doesn't care. When you realize the market is completely indifferent, revenge trading looks ridiculous. Who are you taking revenge on? A cloud of liquidity.
It's like punching a fog.
Exactly. And once you see that, you can stop fighting. You just take the law. If you say, okay, the environment was not what I thought it was, you accept that your analysis was misaligned with the current constraints, and you move on.
That concept of misaligned versus wrong, I think that's a really helpful reframe for people.
It is. Wrong attacks your ego. Wrong means you are stupid. Misaligned just means you are standing in the wrong spot at the wrong time.
I thought the wind was blowing north, but it's blowing west.
I'll adjust my sails. You don't take it personally that the wind changed direction. You just adjust to it.
I want to end on a high note. We've spent an hour telling everyone their analysis is essentially pointless, their ego is the enemy, and the market is a heartless machine. But actually, there's a silver lining here. We call it the liberation.
I think it's incredibly liberating, actually.
How so?
There is a subtle liberation in finally realizing the market doesn't care. When you realize the market isn't judging your intelligence, you stop attaching your self-worth to your P&L.
You stop taking it personally.
Exactly. When you remove the expectation of a reward for your intelligence, your analysis actually becomes much clearer. You stop looking for what you want to see and start seeing what is actually there.
Without the need to be right, you can be flexible.
Yes, you can flip your position in a heartbeat. If you aren't married to the thesis, you can divorce it the exact moment the data changes.
And without the need for acknowledgement, you can respect uncertainty rather than constantly fighting it.
You can admit, I don't know. And ironically, I don't know is often the most profitable stance you can take because it keeps your risk management tight.
That is the key right there. Understanding that markets do not care doesn't make thinking useless. It restores thinking to its proper place. It's a tool for navigation, not a demand for validation.
Think to navigate, not to prove you're smart. We are small boats on a very big ocean. The ocean is indifferent. That sounds scary at first, but it's actually incredibly peaceful. You don't have to control the ocean, you just have to sail your boat.
And you don't have to be a meteorologist to sail. You just have to know how to read the weather report and reef the sails when the wind picks up.
Exactly. Focus on your boat, your risk management. Observe the ocean, the price action, and stop trying to yell at the waves.
I think that's the perfect place to leave it. Markets don't care about your analysis. They never did. But if you respect that indifference, you can actually find a way to navigate them successfully. And I'll leave you with this final thought to mull over. What if the ultimate edge in this game isn't having better data or a faster feed, but simply having a higher tolerance for meaninglessness? What if the best traders are just the ones who are okay with the market making absolutely no sense?
That's the secret. And you'll sleep a lot better at night once you accept it.
Bet you will. Thanks for diving in with us today. Keep your eyes on the flows, check your ego at the door, and we'll catch you on the next one.